young brands. What we were going to do first, though, is we were going to get you guys to tell us what your values were. That'd be kind of fun, I think. These up here. So let's get some values of young brands. And just your estimate of market value per share. Okay? What's your estimate of market value per share for young brands? All right, so what kind of values do you have? Let's start over here. What do you have? Yeah.
I'm so fast.
Okay, how are you?
I've got $12.63.
$12.63. And the market thinks it's way up at 70 something. Wow. Okay.
I got $10.87.
87.
I couldn't find appreciation on those segments.
How about over here? What do you got?
I have something way higher than that.
I don't care.
It's 84.30.
84.30?
Yeah.
Okay. Wow. Okay. Go to the back, next behind you. Behind you. Yeah, there you go.
I don't have a...
Okay, what do you got?
36.30.
Wow, these are all over the place. Okay.
23.56.
Very typical. Yeah. What do we got?
34.
30. Well, we got two of them close together. Actually, the first two. 34 what?
34 even.
Even. Okay. That must be wrong. I'm kidding.
34.
That number's as likely as any other. 0, 0, 4. Yeah.
34.26.
34.26. They're starting to group around there. There's three of them now. Okay.
10.62.
Oh, we got three down there too. Three around 10. Okay. What do you got?
81.24.
Oh, we got two up there now. Excellent.
I got 13.73.
Well, there's another one down there. And those are all close together, by the way. You win a couple bucks. They're close together. Yeah. Okay. Next. Okay. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I don't know how many people we have left in here. 16, maybe, something like that. Right. Huh. So the rest of you didn't do it? No, don't do that. Don't do that. By the way, that's really good. That many did it. Kind of like when you go to work. Some people really deliver and others don't. I don't mean just on this one thing. I mean, I'm thinking, you know. Really? Folks do it, some don't. It just takes a little more work, doesn't it? How many of you really enjoyed doing this? Really enjoyed it. I'd rather do this than sit and have a bourbon or beer.
No.
Play with my grandkids. Those are the things I do, right? You know, I'd certainly rather do this, right? Make your glass full. You know, this is something I'd far rather do, right? Hell no. Why do you do it? Well, it kind of makes you successful. It's a challenge, too. It's all right. Got to do something, right? It's your time. What's that?
It pays for the beer.
Pays for the beer. That's right. You can have better beer. Yeah. I like the new Budweiser ad campaign about not drinking pumpkin ale or something. Instead, drink soap suds. We don't call it soap suds, but it's what it looks like. Yeah. Anyway, a great Brazilian beer, that Budweiser. The owners are Brazilian. Anyway. So let's value them, huh? We'll see who's right, or nobody's right, but who we agree with. You know, I think that it's either somewhere around 11 or 12 or 13, or it's somewhere around the 30s, or it's somewhere around the 80s, or maybe it's around that one. And there's only one person who figured it out. I've had that happen before, that, you know, somebody, it's an outlier kind of, that's not very close to any of them. It's going to depend on the assumptions you made, isn't it, guys? Okay? So let's go pull the information we need, and let's see if we disagree about what information is. Okay? Start that way. So what'd you go find? What was the stock value when you guys did it?
79.16.
79.16. Is that pretty close to everybody?
78.90.
78.90. So around $79 was the value at that time. 79.16. Is that a better number, or is that all right? And then we can just adjust it. Depending on when you did it, right? How many of you were real close to that number? 7916. Okay, we'll use that. Okay, write that down. Somebody, we're going to use that one. Okay, 7916 we are going to use as the value of the stock. Fantastic. Okay, and then what do we need? Where'd you go? For those of you who haven't done this yet, this will be real valuable. For those who have, it'll be kind of valuable. Just look at it. Where do you want to go? Investors. And then what do you want to find in their investors? How about the 2013 annual report? Use the most recent annual report. By the way, in real life, I use the quarterly reports, probably the most recent one. But then you have to do some adjustments. And so this gets the idea. Okay? All right. And now he's going to talk to us. Isn't that nice? Okay. Financials download. Is that what you did? You have to close him first. Get rid of that. Okay. Their ad. Okay. And then what?
Financial downloads.
Financial downloads sound good. I like that. Then what?
Annual report.
You can do the annual report. That'd be a good idea. You don't want the highlights. You want the real report. Cher's a little full of himself there, isn't he, CEO? There's pictures everywhere.
Well,
He's fine.
he's the most.
He's the boss. Yeah. He makes all the money. Why does he need his face everywhere? Okay, anyway. Now what?
Go all the way to the bottom.
All the way to the bottom?
Oh my. Really?
Way down there. Did anybody just search for it?
I did it at work.
Did
I
it?
found their stuff because I work at like an investment firm.
Oh, so you got a real financial statement in print?
Yes.
Oh, wow, that's cool.
Yeah.
The dinosaur age. No, that's neat, though. It's kind of nice to have it printed. Same thing, isn't it?
It's easy.
This is exactly, it's easier to find. You flip two pages. This is, and you can print this, right? You don't print the whole thing, right? But you can print the pieces you use. I always do, right? I'd rather have it in print. Yeah, okay. Anyway, but what could you do? Can you find the financial statements here pretty easy? Hit Control F. I heard that. That works really good. What do we type in? How about balance sheet? Okay, that's good. You guys just leave me alone. I know how to do that. That's good. Enter. Thanks. Did it move? Yeah. All right, so we got a balance sheet, don't we? What'd you take off the balance sheet? Actually, that's an income statement, isn't it?
Keep going down.
Keep going down. Balance sheet is down. Well, that was the first time it did balance sheet. Let's go to the next balance sheet. Next balance sheet. They're talking about balance sheet. There we go. Index to balance sheet. Okay. Okay, there we go. Consolidated balance sheets down there. What'd you pull up here? Okay, you wanted the liabilities. Okay. And they were nice. They gave you the total, didn't they? There they are. So let's write down the total liabilities. What are they? 6427. And these are in what? Millions of dollars? Is that what it is?
Mm-hmm.
Yeah. Okay. So 6 billion. Okay. And then 6701 is the beginning, right? That's beginning and ending. All right. I know they're down to cash flow. Again, why I like to do it on paper. All right. So anyway. So you pick those two up. What else do you want? That's the income statement. What do the balance sheet came after? So it's the income. Okay. Oh, it came after cash flow. The order they like to put it in nowadays. Getting them more like Europeans do. Okay. All right. Now what do you need? What do you use those liabilities for anyway? The ending liabilities you're going to use for your weights. The average liabilities you're going to use for your interest rate. Yeah, that's the way I like to do it. Okay. Variety of ways people do it. Okay. What else do you need? Anything else up this balance sheet? Depreciation? No. Right? Why not? That's accumulated depreciation. I want depreciation expense, don't I? Okay. So anything else here? I don't think so. Okay. Where else would you look in their statements? Cash flows. That was right before, wasn't it? What are you going to pick off the cash flows? Depreciation, we hope. Is it there? Should be. Depreciation, amortization. You want them together. Amortization is also a non-cash item, isn't it? So what's that? 721. Everybody pick it up. Okay. Somebody write it down. Okay. Then what? Anything else off the cash flows? How about income statement? Look at that. Okay, you don't have to do comprehensive income. There are no cash flow items there. Okay. So what do you want to pick up off the income statement? Interest expense would be good. Is it here? Yeah. There's interest expense net, and you could get fancier and go to the notes, the financial statements where they talk about interest, and find out what the expense really is, because this has the interest revenue against it. Or it's probably close to 247. Okay? They don't have a lot of interest. Why don't they have a lot of interest? Because they're a big company, very wealthy. They don't have an amazing amount of debt. They have some debt, right? And it's not huge compared to their other numbers, is it? Okay? It's still significant. So write down the 247. We'll use that. Okay? Then what? Income before income taxes? Really? Do you want that number? Maybe. Maybe. Maybe not. What do you want to do?
Just divide the tax. You can see that.
No, I don't think so. If you get the tax rate, I am going to use the tax. I do that. We'll do the tax rate that way. But do you want to just pick up that number? No. What you want to do is you want to go up and look at their revenues and look at their expenses and make sure they are going to continue into the future. What if you have a revenue item you have 1 year and you don't have it in the other 2 years? You better figure out what that is, and is it going to be continuous forever into the future? We're trying to predict revenues forever. Oh, the same with the expenses. What if I have something like reorganization costs in one of the years? You don't have that every year. What if I have a big gain or a big loss on disposal of something? I don't have that every year. Don't do it, okay? So don't take income from the income statement without checking everything out. So do the company sales look like they're going to continue year after year after year? Yeah. Looks like it's growing, right, a bit, okay? How about the franchise fee? It looks normal, right? It's continuing, okay? How about, in fact, on Target, wasn't it Target where they used to have a credit card, right? And now they don't? You better leave that stuff out. They're not going to have any credit card income anymore. They're not going to have a huge gain on their credit card anymore, right? You don't get to sell it over and over. They sold the business once. Leave that stuff out. Are they going to have credit card expenses anymore on Target? No. You got to leave that out, don't you? How many of you left that stuff out when you calculated it? Yeah, but you cheated. You talked to me about it. Had you already left it out?
I asked about it.
She asked about it, yeah. Oh, what do I do with this stuff? You got to look at each item, you guys. Now with this one, you look down at it. Is there anything that looks really unusual? Other income expense bounces all over the place. Luckily, it's not real big, so it's not too material. Refranchising, I'll say it. Gain or loss bounces all over the place too, doesn't it? Closures and impairment income tax expense bounces all over the place. Everything else looks like they're fairly standard. But you know what? I could take these three. The 331 less the 100 is 221. Less 16 is about 205. Positive, that didn't help much. I could add these two together, 200 negative. Oh man, that didn't help very much, does it? Right? They're still bouncing around. And then there's 200 less 53, so it's 150. So I don't know. I guess I'll leave them in. I don't know what's going to happen next. Right? But you need to use some judgment here. Everybody got the idea? Okay, so did anybody adjust the operating profit? The income before income taxes at all by any of those? I don't think I would either on this company. Got it? Again, what if I had a big line, reorganization costs, for $1 million or $1 billion? And it's in 1 year. Better leave that one out. That's a huge difference in how you value it. Okay? So you're trying to predict the future here, not the past. I know what the past is. Sitting there. Okay? Well, that's what it is, please. Okay, so if you want, you can pick up revenues of 13, less normal expenses of all these expenses, whatever they added up to, right? 11,286, I guess. And you get $1.8 million, or $1.8 billion rather, of income before tax. Okay? Oh, I'm sorry, $1.8 billion less than 250 of interest. We got $1.551 billion income before taxes. Now what do you want to pick up here? So you can pick that one up if you want. It's all right. You think that's normal income? I don't know. Was 2145 more normal? Is 1551 more normal? And what caused the big difference? It's all this impairment stuff in here, isn't it? I don't know. This is a tough one. So valuing this is kind of difficult.
The 1551 is more consistent with the year before.
It is. The 2 looked pretty high, didn't it? And a lot of it was refranchising gain and other income expense gain, isn't it? So maybe it's more conservative, I don't know. Now what do you want to do? Calculate the tax rate maybe? How about taking 487 and divide it by what? Write down the taxes 487. What would you divide it by? What were you going to suggest earlier? The income before taxes. What's 487 divided by 1551? What'd you get?
Yeah, 31.4%.
31.4. What was the year before? 537 divided by 2145.
25%.
Oh, geez. What was the one before? 324 divided by 1659.
19.5%.
What's the tax rate? In the future.
What this year's is.
You like this year's? Why?
The most current.
So what? What if it's just 1 year they had higher taxes for some reason?
Looks like it's been going up each year though.
Been going up each year? Why does that happen? Dumb branch. Lots and lots of international business. They were one of the companies that were finding ways. They were very, very aggressive. In fact, people graduated from Bellarmine and went to work in their international tax division. Real bright people, right? Really sharp people. And their job is to do what? Get taxes as low as possible for young brands, legally. They were extremely aggressive. Lots of companies were, and they still are. There are companies that are, U.S. companies that are buying foreign operations. They merge their operations with them, and they pretend like they're a foreign company, so they don't have to pay taxes in the U.S. You guys have seen this in the news, haven't you? You know, and the administration, the president is really upset about this. They're trying to pass laws to stop them from doing it. I think they should not let them sell their products here. That'd be a good law. They do that. Fine, you lose this market. We're going to have to do a value-added tax. What's value-added tax? Sales tax is awful. Europeans have gone to this way. They go to it because everybody was playing this game. I don't have any income in your country. I have income in the other country that doesn't have any taxes, right? Low tax rates. That's where we really are operating. Even though I'm selling to the country, so that you collect no taxes, right? But we're doing business in your country all the time. So what they went to is basically a national sales tax. So they collect taxes. We're going to probably have to do the same thing. Because people are taking all the income offshore and not paying any tax in the U.S. on it. So you hear about major corporations paying absolutely no income tax. That's one of the major ways they do it, right? It's legal. Our tax law lets them do it. Okay, so what were they doing here? They were really aggressive. Year after year after year, they were down at 19%, 20%. Now all of a sudden they're at 30? Really? You know what you could do is you could find out about that by looking at something in here. What do you have about income taxes? I wish they said it right on the face of the statement. Some companies do, but a lot of them don't, and they didn't. They'll refer to the note number right on the face of the statement sometimes. Sometimes they don't. Did anybody go read the income tax note? Oh, could we do that? Yeah. Because I don't know which one of those makes sense. Should you use an average of them? Did anybody use an average of those tax rates? Did everybody use the most recent one? Just because it was the only one you calculated? Is that right? Is that what happened? Oh my. So let's do this. Let's see if we can find income tax. Well, that's the income tax. Here's what they do. Deferred tax. This is income taxes in the note, the summary of significant accounting policies, right? Okay, so they got a variety of things going on there. Okay, but probably the next one will actually give me the tax note. Well, the next one might give me the tax note. See note 17. Where we are. I should type in note 17. Everything's netted income taxes. Income tax, there we go. Note 17, income taxes. Okay, look at what they did here. They show U.S. taxes. Look how much bigger the U.S. taxes are, right? And then foreign taxes, okay? So they got the taxes there. Details of our income tax provision or benefit are set forth below. Current portion, the deferred portion, and here's reconciliation. Okay, here's the U.S. federal rate. What is it? 35% for all companies, right? And here's the statutory rate differential attributable to foreign corporations, which is a big adjustment they have, right? And then net benefit from divestitures. Oh, that was a big one that they had here that saved them a bunch of tax dollars, right? So what's the big gain that they're having in taxes? What's going on? Adjustments to reserves in prior years. They've got that going on. That's 5% going the other way. So does this help you at all? Yeah, a bit. If you read through this note, though, these benefits was negatively impacted by the repatriation of current foreign earnings to the U.S., so they're going to have to recognize additional tax expense because they're bringing foreign earnings back into the U.S. Okay, so you find out about that. Okay, so, and it was positively benefited the year before, so between 2012 and 2013, or 2011 and 2012. So just look at it real quick without reading it. But if you read through this, right, in 2013, expense was driven by $32 million for valuation allowances recorded deferred taxes. The $9 million tax benefit resulted from a change in judgment regarding the future of certain deferred tax assets at the beginning of the year. So they're becoming far less aggressive is what the real message is to read this. So what do you think a really good tax rate for them would be? That's a tough decision. It really affects the value of the company. What do you think? You're going to like this. It's probably the most recent year. Because they've gone away from being real aggressive. Last year, I wouldn't have known. 19 or 25, what are they going to do? Because they've been 20 year after year after year after year after year. I thought it was 20. When we used to value this company, it was 20. So all the taxes they were paying, 20%. Right? That's because it's not. Because I paid 35% of my income. Young brands, as rich as they are, just pay 20. That's what income tax. I don't like that very well. Right? But it's different. Right? A lot of companies pay a lot less. Okay? So anyway, you can always go to the notes. Notice what they did in the notes too, though. They actually calculated what the effective income tax rate is. You didn't have to calculate it yourself. There's the 31.4, the 25, and the 19.5. See it? Okay. So what else do we need? Anything else from the financial statements? You got interest, you got average debt. That was it, wasn't it? So you want to use 31%? Sound good? How many use 31%? Okay, yeah. So, anybody use a different one? Okay. All right. So where else do you want to go? What else do we need? What else did you pick up to make this go? That was everything from the financial statements, right? You want to look at how many shares of stock they have, though? That might be good. Okay. We can do that before we leave. Okay. So let's see. Down here at the bottom of the balance sheet, I bet it says how many shares there are. Common stock, 750 million shares authorized, 443 million shares, and 451 million shares issued. And there's no treasury stock. What they probably do, they bought back some stock and retired it, didn't they? Because it went down, right? Number of shares. So which number do you need?
43.
The 443. There's no treasury stock, right? So outstanding and issued are the same thing. Okay? So 443 million about, and then we'll compare that to what the market thinks, right? Well, what the market knows, okay? How many are out there? Okay, is that it for the financial statements? Okay, now what do you want to do? Whoops. Go where? Yahoo Finance, maybe? Is an okay place to go. MS Finance, Yahoo Finance. Okay, and then what?
Find the beta and the stock price.
Okay, so how are you going to find that? You can look up anything, can't you? Okay, so who should we look up? Yum? You did this, I hope. There we go. New York Stock Exchange. So the previous close was 79.16. That's where you guys got that, I bet you anything. Okay, and today it's gone, well, it went up, now it's gone back down a little bit. Okay, 79.45. All right, and where are you going to find the beta? It's right there. It's 1.0. Is it really?
Yeah.
Why is there beta right around the market? Man, that's right on the market. Why is it 1.0? They track exactly with what happens in the stock market as a whole. They are real big, and what do they sell? Fast food. What happens when times are good? Poorer people buy their product. True. They can afford it. What happens when times are bad? Wealthier people buy their product because they can't afford the fancier stuff as much. So middle class goes down into McDonald's, right? And lower middle eats at home. Or don't. Right? Going down. Okay. Really? So what always happens with them? They're not way high yet. They're not at the way low. Not really. Okay, what's the deal? They're always pretty straight. Yeah. People always get their fat fix at Young Brands stores, right? Who's Young Brands? What products do they have? Before that would make any sense to you, what are they? KFC? Taco Bell? What is it? Pizza Hut. And there's one other one in there. Did they get rid of the fish place? They did. Do they still have Long John?
They had A&W.
No, they have 5. Long John's and A&W. They sell A&W.
I think
They have the other 4. Yeah, whatever it is. Okay. They were called Tricon once. I thought it was the dumbest name when they started because they had 3 brands. So they called themselves Tricon. When they bought the other brands, they had to change their name. But Young's kind of cool for a fast food company, don't you think? Right? They're real into health food, I think, these guys. Right? So, but anyway, yeah. So anyway, we really like this company. You know why we like them? Because it's a Louisville company, of course. So they couldn't be doing anything wrong. Not like that McDonald's. Okay. Anyway, so it's not a Louisville company. All right. So what else do you need from here? We get the stock price here, right? It's the same as was on the company page, of course. Okay, so 79.16 is what you guys picked up before. You want the beta? 1.0. Okay, then what? I didn't know it was 1. It didn't used to be 1, but it was close. Of course, it changes over time. What else do you need? Anything? Number of shares? Well, yeah, but it might not be the same because it might have changed dramatically. What if they do a stock split or something, right? So I look at both of them, make sure they're somewhere around the same. Where would you find that? Okay, let's do key statistics so we can get a little more information.
So, left-hand side.
Either way, right? Okay. So what do we have here? The beta is 1.00. Amazing. Okay. And then what? Share statistics down there, shares outstanding. I like this number a little better, don't you guys? Because it's got more decimal places. Is it pretty close? Yeah. Okay, so 433.12, I'd probably use that one. Okay, you know what they do here for you too? They actually calculate market cap. What's that? 34.42 billion. That's the outstanding shares times the price right now. Ah, what'd you get from market cap? Total market value of the equity. What'd you get? When you took your outstanding shares, right, which is the same one system, probably close in here, right? And then you took that times the market price of that day, right? What'd you get for market capitalization? 34.2. Yeah, so it's worth a little more because the price is a little higher today, right? So we'll use the 34.2, of course. Everybody got it? Okay, that's what you guys use. Do you need anything else here? Should you use the financial highlights from here? The income statement, the balance sheet stuff from here? No, don't use that. It might give you exactly the same numbers, but it might not. So I wouldn't use it if I was you guys. I'd go to the real estate. Do anything else? Oh, we better find out about T-bonds, right? Because we're going to need a risk-free rate. And then I think we got everything we need, don't we? I think we got it all. Okay, so easy to find, I think. Where would you find the risk-free? Okay, go to where? Market data. Where do you see market data?
Right above your mouse.
Right above my mouse. Market data. How about that? I didn't mean to put it on. Sorry. Okay, market data. So what do you go down to? Bonds, maybe? Now you can type in all kinds of bond stuff, but if you do, you know what happens to you? You get all kinds of garbage comes up, right? And you have to find the right one. So this just gives it to you. Which one do we probably use? Richardson's preference. It's just Richardson's. Other people have different preferences. 30-year, 2.81. What was it when you guys did it? 2.72. Okay, they're starting to inch up. Why do you think that is? The economy is doing really, really well. Unemployment down a little bit more. Stock market's still going up. People are starting to speculate what Federal Reserve's going to raise interest rates. At some point they probably will. They're really, really low, abnormally low. Do we need to keep stimulating the economy? And wages have even started pumping a little bit, it looks like, right? Okay, cool. Okay, so lower income people are actually starting to get a little bit of the effect of the economy recovery. You know what the stock market's done in the last 6 years? I heard this morning it was 6 years, not the last 7. Tripled. We calculated the rate of return on that in my principal classes. So they're doing present values. It's 20% per year for the last 6 years. The stock market is there. 20% less risk-free, right? It's the return, the real return on the market. What's risk-free then? Low, huh? What's risk-free? 2.81? Yeah. So take 3 away from 20, 17% real return? Yeah. For the last 6 years. But what happened a couple of years before that? We lost half of that. So, you know, it's over a lifetime, right? So it's over your life of investing. Okay, good. So we got all the information we need. Now what do you guys want to do? Let's close on this. How did you calculate it? Let's go. Let's see where the calculations went haywire did, or didn't go haywire. What do we got? Estimated cash flows. Okay, so let's get some estimated cash flows from you guys. How did you calculate your estimated cash flows? Net income before tax. What numbers you use? 51, 1,555,000,000, right? That's what it was. And then you're going to take that times 1 minus the tax rate. Now this seems silly if we just took the numbers off of the income statement, which we did in this case. But if you don't take the numbers off the income statement, do you want to do it this way? Yeah, right? What do you think normal income is and normal tax rate? So go ahead and use the formula, of course. Okay, take that times 1 minus the tax rate. What did we say the tax rate was going to be, we thought? 31%? So 0.31 maybe? So the government takes 31 cents out of every dollar, we get to keep 69 cents? Yeah, okay. And that's going to give me what? Oh yeah, this is going to give me what? Net income after tax, right? That's all that is. Okay, normal operating income, okay? So you could do that, right? Or make it all one formula if you want, of course. And what would that give me? Plus depreciation and amortization? Okay, depreciation and amortization. How much was that? 721. 721 million. Yeah. Okay. And what do we get? Cash flow. That's my estimate of cash flow. How much? 2. That doesn't sound right.
No, I got
That's too big.
1791.
Because what we've got is after tax would be 70% of $1.5 million, right? What's that, $1,000,001 or something, $1,000,002 plus 721? What'd you get?
1791. Sorry,
1791. Okay, 1791.19. Yeah, you can put your decimal wherever you want. Okay, all right, whatever you think's material, I guess. Okay. So I think that's the estimated cash flow too. That sounds good? Everybody like that one? Or close to that? Okay, then what do we need? We're going to do the estimated cash flows divided by the WACC, right? Okay, so let's get the WACC. Okay, so the weight of the debt times the cost of the debt plus, yeah, good. All right, so let's do it. Okay, so how do I get my weights? Yeah, I want the market value of everything, don't I? Market value, not book value. Maybe some folks did that. That's kind of common. Okay,
The liability still there.
I'm going to use the book value of the liability as a proxy for the market value. But I still think it's the market value. It probably is fairly close.
Yeah.
Usually is. Okay, so what do we have for the book value of the liabilities that we're going to use as our proxy for the market value?
6427.
6427 was the value at the end. Okay, 6,427,000,000. Okay, equity. How many shares do we have?
443.12.
Is that million shares?
433.12.
433.
Yeah. Millions.
And make sure you're in the same, right? Millions and millions, apples and apples, right? Okay, same base. Okay, that's outstanding shares. Good. Okay. And what was the market value we said?
79.16.
That's what the market thinks it's worth. So what's 43312 times 79.16? That's my equity, isn't it? That's the market cap, too, at that time. So you just take the market cap if you want. But again, make sure the shares agree, so they're apples and apples.
34285.77.
34286, maybe?
Yeah, that's right.
Okay. Somewhere around there. Good. Okay. Add the two together. That's the market value of each, right?
4713 for estimates.
47013.
4713.
40713. 40713 or 713. Hereby decree that's 100% of itself, right? Take the 4713 and divide into each of them and make sure they add up to 100%. Sound good? What's 6427 divided by 713? 16. I think I'd probably keep a decimal, maybe, something like that, right? Just in case it makes a difference, okay? I'd leave a little bit there, okay? And then what?
Which was 84.2.
Okay. Good. All right, so I just plug them in. The better off the company is, the less debt percentage and the more equity percentage. You know, just what happens is as the market price goes up, it goes on up. The market price goes down, what happens? Now all of a sudden the debt percentage is more. Got it? Okay. All right. So what will you do next? KD? What's KD?
Your interest rate times 1 minus your tax rate.
How do you get your interest rate?
Take your interest expense divided by your average debt.
Yeah, that's it, right? What's your interest rate? Then, let's see. The interest expense, this is just one of the ways of doing it. What was interest expense?
247.
247? What was the average debt?
6564.
You take this 6427, add the beginning to it, divide by 2. Man, maybe that's a little better than just using the ending, especially if it changes a whole bunch, right? Finance people would just use the ending. I don't care, right? It's okay, right? So what is that? What is that? 65 something.
6564.
And then you just divide 6564 into 247, and how low is this? It's almost nothing. Tiny. What's that?
3.8%.
How come their interest rate's so low? If you look at their balance sheet, they have a whole bunch of borrowing that is what? Interest-free, right? Accounts payable, accrued liabilities are interest-free. Some companies it's far less than this. But Young Brand borrows money to build stores, right? So they have a fair amount of debt that's interest-bearing, right? So 3.8 is still a pretty low interest rate, isn't it? Even nowadays, okay? Still pretty low. So there's this 3.8%, but that's before taxes, isn't it? And the government's going to pick up how much? Every dollar that you put on your tax return of expense, government's going to pick up how much of it? 31 cents. Use the same one in both places, guys. So we only pay 69 cents of it, right? Got it. So what's 3.8 times 0.69? 2.6% maybe? Okay. And you can keep as many decimal places as you want. Okay? All right. KE, what's that? It's our next one over here. What do we do with KE? We're going to use the capital asset pricing model, aren't we? What's that going to be?
It's the risk-free plus the beta times the market risk premium.
Yeah. And the market risk premium is what? Return on the market minus risk-free.
And we use...
Which is the market risk premium, right? Did I give you a risk premium, or did I give you the return on the market, or you neither one?
You gave us
gave us
10% for...
I think it's, we're supposed to take 10% off the risk rate, because that's what it is. Or minus.
Oh, minus the risk rate. Yeah, I said maybe the market's going to earn 10% forever. Yeah. Why did I say that? Because the risk-free was how much, guys? That 30-year?
2.8.
Yeah, and I said, well, you know what? If that's that low, then the risk premium, if it's 7, which is a pretty high risk premium, would make it 10. You see what I'm doing? Okay, so what happens if inflation fires up and we start having higher interest rates? We're probably going to have higher ones someday anyway, and in the course of your career, you'll see it. I'd like to not see it until I retire. Then I'd like them to skyrocket, because then I can invest in interest-bearing stuff that's lower risk. No, no, I wouldn't like it to skyrocket. It's bad. Okay, but I want the market to do well. So I like low interest rates, but maybe not quite as low as we are, huh? Okay, and we certainly don't want deflation. You learned that in your econ classes probably, that we don't like that idea. It's scary. You don't know what happens when that happens. In the instances where there has been deflation, it hasn't worked out well, right? So, okay, so anyway, so you see why I used 10? Suggested you guys use 10? What does that make that risk premium over here?
7.2%.
Yeah, if return on the market is 10% and you subtract 2.8 from it, use the same risk-free in both places. It's risk-free, right, guys? It's the return you get without any risk. 30-year treasury bonds are not a bad estimate of that. So the risk premium here is 7.2%. Does that sound reasonable to you? Yeah. I don't think the market's really going to keep earning 20% a year forever. Do you guys? Just because it's earned 20% a year for the last 6 years? I really don't think that's going to happen. Okay? So anyway, all right, it'd be something to do, all right. So what's cap in? Oh, beta is 1.0. What if beta was 2? Then you'd be doubling up that risk premium, wouldn't you? What if beta was 0.5? Well, you take half the risk premium. Everybody got it? Pretty straightforward? So 1 times 7.2 plus 2.8 will just get us back to our 10.0. That will almost never happen, right, guys? That's real unusual. I didn't intend to pick a company where that happened. It's only because the beta is exactly the same as the market. So your company's cost of capital is exactly the market's cost of capital. Got it? The return on the market. Usually it's going to be slightly higher, slightly lower. What if I had a beta of 3, though? What would it be? A real risky company. Beta of 3. Lots of variability in their returns. What's 3 times 7.2? 21.6, and you'd add 2.8 to that, and you'd be up, what, 24%? Get the idea? What if it was a real low-risk company? It's 0.5. 0.5 times 7.2 would be 3.6. Add 2.8 to that, and where are you, 7% or something? Got the idea? It'd be a real low cost of capital. So we're going to use 10% as the cost of debt. Okay, here we go. What's my WACC? Each one of those multiplied together mean nothing, right? What I would do, by the way, is put a point in your calculator, 0.158, and take it times 2.6, and it'll keep it a percentage. Convert one of them into a percentage and leave the other one, or leave one as a percentage and convert one into a decimal, and you'll have an answer that's a percentage. Easier to keep track of. If you turn them both into decimals, it'll give you numbers that's easy to get in the wrong decimal place. Does that make any sense at all? So I put in 0.158 times 2.6. What's that? Be careful where you put your decimal.
0.4108.
So, okay, so maybe 0.41, okay, or 42, okay, and then what's 0.842 times 10? 8.4?
Yep.
8.42, I guess. All right, so add those two together, and I'll keep my decimals to a reasonable level. Let's say 8.8%. Does that sound good? 8.83, but 8.8% is probably good enough. That's my whack, and now I have it made, don't I? What am I going to do now, everybody?
Take your estimated cash flows divided by your WACC.
You got it. This divided by that, and I'm going to find out what the assets are worth. So my estimated cash flows are how much?
91.
My whack was 8.8. 0.088 into 1791 is what? How many billions is the assets worth? This is my estimate of the market value of the assets.
2215.
2215.
I got 23 bucks.
Yeah, that doesn't sound right.
Well, I used 1785 because I used a different decimal for
Okay. And you used
divide by 0.0883.
0883. Okay, but 1791 divided by 0.088. Where do I put this decimal place? Be careful. What is it?
2352.
Remember 220.
20.
Oh, okay. I thought you were giving me the wrong decimal place. 20. Okay. 352. And you had
2215.
2215 in material difference. Right? We're just guessing. We really are. Okay? So what do you think? Where do you think you should put your decimal place? Did that one, didn't it? Okay? Yours is more accurate computationally, but they're all estimates anyway. So I don't know. You guys close to this one? Then what do you want to subtract from it, of course?
Market value of your liability.
Estimated market value of the liabilities. Good. It's just making common sense. See, I'll let you use the formulas, but do you really need them? I doubt it after a while. Working a few times. What for? Okay, what's the estimated liabilities? It's not the average, it's the beginning or the ending, right, guys? Okay, that's what we did our weights on. So what did we use?
6,400.
Okay? Or 6 billion, that's close to 1,000. Okay, anyway, yeah, fine. All right, so 2352 less 6427. What's our estimate of the market value of the equity?
139.25.
13925.
925.
Everybody like that one? 13,925,000,000. Divided by what? Outstanding shares. How many was it?
443.
The same ones that we had up above. 443.12, whatever. Okay? And what do you get for your estimate per share?
31.42.
This isn't the market's estimate, it's your estimate, right? Okay? For the weights, we use the market. And I know that's circular reasoning to use their estimate to make an estimate, but that's a flawed formula. Okay, in the theory. How much is that?
31.425.
Okay, we think it's $31.42. Those of you who got something else, do you know why?
I got 34, so.
That's right. Anybody that's around 30 to 35,
I know why I got the really low. I used 0.8% for risk-free return. That's why I found somewhere on Dub's financial statements. I think it was their treasury bond, what they issued it for or something.
oh, okay, nah.
Yeah, I used
nah.
that.
We don't want theirs, we want everybody's. Okay, so I can understand that one. Okay, so theirs is even less. That's because they're real short term, right? Real short term rates are lower. What else? Did you guys tell what happened? Is that what happened with the people who got down around, what'd you get, 10?
Yeah, I got it. So I got
you got
63.
63. How about people who got 80? You know what you did wrong?
12.
What happened?
I think I did the weighted equity wrong.
Okay.
Yeah.
Didn't maybe use book value or something weird?
Yeah.
Okay, all right. How about those of you who got around 10 to 12? What happened there?
Yeah, I messed up on the towards the end on the I don't know what it's called. The little numbers, computing them.
Just computing the numbers? Decimal in the wrong place, maybe?
I
That kind of
also
stuff?
not added depreciation in. I looked, but I couldn't find it in their income statement.
Oh, but it's not in their income statement necessarily. And it might not even be the same in the income statement because they might put it in several different places. Some could be in cost of goods sold, got added to the inventory first, and some's in inventory, some's in cost of goods sold. Go to the cash flow statement. Okay? Any other? Okay, then what's the rate of growth, guys? Now that we have that, what do we do for rate of growth? Let's work back, okay? Let's take our estimated cash flows, just really quick and dirty on this. Estimated cash flows divided by WACC minus growth. And really what we should do is take the estimated cash flows times 1 plus growth, right? But let's just, for quick and dirty, let's get close here. Let's put in 1791 here. WACC is 8.8%. Whatever growth is would be subtracted from it. Everybody agree with that? This is G, okay? Whatever growth is as a percent would be subtracted from it, okay? And that's what we have to earn because we're getting growth anyway. So we have to earn whatever's in excess of growth. And what I want is the estimated market value the market believes the assets are. What's the estimated market value the market thinks on the assets? We already know that. We did our weights, didn't we? What did we have when we got our weights, everybody? When we did our weights up here, what do we have? 34,286, right? Is what they thought the equity was worth. Everybody agree? That's the market cap. The number of shares times the market value per share. 34,286 plus the debt. We're assuming they agree with us on how much the debt's worth. We're assuming they agree with us what the market value of the stock is. Of course, they probably would on those, wouldn't they? And then we add them together and we get 4713. So they think the assets are worth 4713. Everybody agree? And in our review session, we'll really beat this up. Okay?
3 to 5.
3 to 5
Yes.
today. Yeah, I didn't mention that. Yes, it is. Then we got another one Wednesday, don't we? For a quiz?
We have a test this
For a
weekend.
test. That's a 2-hour one, too? They just love you people or what?
On Wednesday. Do you know what time it is on Wednesday?
It's on the schedule now. They're both 3 to 5? Yeah, yes, they are. Whenever they are.
Yeah, it is 35.
They're both 3 to 5, are they, on the schedule? All right, good. You guys like that time better anyway?
No, well, I've been interviewed on
Some
Wednesday
don't.
at 3.
Yeah.
If you,
So
if
that's
we
fine.
flip section Tuesday, we won't be able to get it until like 4:30.
Yeah. Okay, so can you solve for the G here, you guys? Take the 1791 and divide it by 4713, and what do you get? The market's pretty optimistic about growth on Yum right now. Actually, the stock's probably overvalued too. Everything's overvalued right now, probably a little bit. Everybody's excited. Market's real high. I don't know. I'm guessing. Nobody knows. If I knew if the market was overvalued, I could place bets, capture all the wealth in the world, right? If I knew when it was over and undervalued. So everybody's trying to guess that one. So what's 1791 divided by 4713?
4%.
4.0?
4.4.
4.4%. Oh my gosh. How much growth does that imply? 4.4. This is an interesting company, isn't it? Everybody see G would be 4.4? That's it. Get this intuitively. What if I asked you to value it with growth of 1%? I think it's really only going to have 1. It's supposed to be forever, by the way. So, yeah. Could you value it? Just plug 1 in, right? Put 1 where G is here, and then take this times 1 plus growth 2. Okay? Be a little more accurate. Yeah. And then you'll get the market value of the assets and do what? You got the liability, you got the equity, divided by the outstanding shares. Boom. You have the estimate at 1% growth. So you can calculate what the company is, your estimate was no growth. You can calculate what the growth must have been because the market thinks it is. And then you can calculate what? For any estimate of growth that you think is reasonable, what the market value should be. Got it? This is handy stuff. It's really useful. This is sort of the tip of the iceberg for really being able to value this. Okay? Those are going to be finance majors that do a whole bunch of this stuff. And we'll do some in the MBA too, for that matter. A bunch of these. So I'll see you guys in a couple hours. Oh boy.